The Fed uses rate cuts. If inflation is high, what you do is you raise the value of the US dollar by raising interest rates.
Yeah.
When unemployment starts getting too high, you lower rates so that businesses can get loans for sensible purchases, building a new factory, building a building, adding equipment. You see what I mean?
Gotcha.
Sensible. And they're supposed to delicately turn the dial. Kind of like, have you ever been in a hotel where if you turn that shower just 1 inch, it's way too hot, and you turn it another half inch, it's way too cold?
Yeah.
That is, think of that's the way that a sensible Fed is controlling interest rates in our economy. Just think of it that way.
Gotcha.
A lot happened yesterday. One first rate cut in God knows March of 2020. 4.5 years since March of 2020, there's a rate cut. However, everybody's asking, why is the market tanking? Why did the market tank in the opposite, react in the opposite way? Not tank, interest rates. 11 times in 6 months, we raised the rates. Never in the history of America have we done this. We haven't touched the rates for over a year. And the last time we lowered the rates was 4.5 years ago, March of 2020. Jerome Powell making this announcement. He comes out. Everybody's expecting 1/4 point. It's not going to be anything. It's only going to be 1/4 point. And then all of a sudden, he says, nope, we're going to 1/2 point. This is not good. Okay, this is very good money-wise. Yeah, we made a quick, $20 million say on the house. Yes, but if this continues, yeah, it's going to be a very, very catastrophic issue. When you see numbers like this and 1 year go like this,
not good.
It's not real. It's fake. It's purely temporary, by the way.
There's a lot of these labor statistics and unemployment. The Fed's going to go faster on rate cuts if it's worried about unemployment or a stagnating economy, like slowing down. So recession, unemployment, whoops, got to drop the rates. Well, recession, everybody's been thinking it's recession or thinking we're in a structural recession right now, but it's light. And the labor numbers keep getting revised. So everybody, including the Fed, had been saying, some of these labor statistics, it's troubling to see them revised. They were missing 100,000 jobs. It came back a week later. Oh, yeah, we're sorry. It really was 100,000 different. Sorry. Meanwhile, the White House took credit for creating all these jobs, and they revised it a week later.
Tom, but what's the average person right now? So the stock market dipped after a historic Fed rate cut. Here's what experts think. Here's Fortune and what they think why this is taking place. So Federal Reserve cut the rates by 1/2 point, calling it a move to demonstrate officials' confidence that the labor market can stay strong with appropriate recalibration, despite the Dow dropped 1/4 basis point. And Robert Frick, corporate economist at Navy Federal Credit Union, noted that 1/2 point cut is an admission the Fed is behind the curve. The market reaction saying the market has priced in a rate path that looks more like what an impending recession would require rather than the Fed's less aggressive recalibration. The Fed's outlook of 2 more 1/4 basis point cuts this year. That's a full-on 100 basis points by 2025. Disappointed investors. Powell insisted that the U.S. economy is in good shape, but his comment that we're not going back to near zero rate caused unease. Watch this. Every time we've cut rates the first time, historically, when there's been these climbs of rate increases, and then there's the first rate cut, how much does the stock market drop after the first rate cut?
Historically, the market usually reacts down because the market is usually talking about what it needs and the economy is showing what it needs. And when the Fed finally responds, usually there's 2 theories, Fed chase and Fed ahead. Fed usually chases because Fed looks at history, whereas the stock market is always speculating, it's always ahead.
Yes, exactly.
The federal fund rate has increased 10 times in 14 months. I think it's 11 times in 16 months. So if you look at that, that's the cycle that we've been going. Bam, we went up. So the first rate cut happens, and then it shows the average of how much the decline is, 20.5%. After the first rate cut, the market tanks 27.6%. In 1980, it dropped 2%. 1981 dropped 22.6%. 84 dropped 1, 89 dropped 8, 95 dropped half, 2001 dropped 42%. Okay? If on average, if we go based on this, there's going to be a 20.5 market correction within 3 months to 18 months based on history. That's what this is telling us.
Cash is king. Save that money. You never know what's around the corner. When the tide goes out, we're going to see who's actually being smart with their money. So it starts from the top, and whether it's an organization, whether it's the head of the household, if you sort of set the tone, this is how we handle money here, guys. We're not going to just be lavishly spending when we can be saving, because when the time is right, we're going to have this opportunity to buy something very unique for the company that the Fed, Jerome Powell, he's got one main job: control the economy. He has two basically things that he does to control the economy. Number one, he has to deal with employment and unemployment. He has to manage that.
Yeah.
And the other thing is managing inflation.
He just came out yesterday, I think, right, Robbie? And he blamed the migrant crisis for this growing unemployment. He said, if you're having millions of people come into the labor force, then you're creating 100,000 jobs. You're going to see unemployment go up. He was saying, so it really depends on what the trend underlying the volatility of people coming into the country. So this whole, every time I hear Kamala and then brag about, Pat, how amazing the economy is doing, they're full of because it's been steadily going up since spring of last year. And after starting the year at 3.7, it stood at 4.2 in August. The U.S. has slowed down in adding jobs in recent months with a disappointing 142,000 in August that fell short by 20,000 jobs.
This is the real news you want to know about why the market hasn't tanked. And when you look at this chart, this is the Fed funds and the lag effect, the delay. The graph below shows the Fed fund rate and the time as measured in months from the last in a series of rate hikes preceding each recession since 1981. So, meaning they're increasing the rates, increasing. Boom, they stop raising. How long did it take until recession hit? If you look at these numbers, you'll see a 15 months, 8 months, 17 months, 10 months. You know what that means? It takes roughly 11 months from the moment we stop raising interest rates that recession appears. Again, if this data is real, a month before election, there should be a recession in America based on this chart. That's what should happen. Some people may say, well, Pat, how come more corporations are not filing bankruptcy? How come all this stuff that happened in 2008 is not happening today? Because these corporations, if you look at this chart, what they were doing is the money they took, companies were taking millions and billions from banks saying, go get some more money from the bank because it's so cheap. What do we do with the money? Just set it aside. Who cares? Well, go get the money. Yeah, but the rates are only locked for 3 years or 2 years or 4. Go get 50 million. Go get a billion. Go get 100 million. And they did. So what did these corporations do? They took that $50 million at 3% and they bought bonds. So the difference, let's just say the bond's paying 6%, the 6%, 3%, the 3% they're making on top of this, okay? We're making 3% on 50 million bucks. Every year we're making $1.5 million in interest. This is awesome. We should have borrowed more money. However, if you look at this chart, you know what's coming up? Here's what's coming up. When that expires and it matures, and then it goes from 3% to 8%, they're going to be in deep trouble because they have to make those payments. They can no longer make money on that. So what do? That's when they have to say, hey, we don't want this loan anymore. Let me give it back to you. If they have the money, or two, bank's going to say, we're expecting a payment. Do you have it? Can we wait another month? Can we wait another 2 months? This is why a company called WeWork that was valued at $47 billion in 2017, where SoftBank gave it $18.9 billion investment, defaulted on a $95 million payment. We haven't seen a lot of this yet. This is coming soon.
Agreeing to want to put $7 million into one project that will probably end up being a $12 million project. Another one, I'm deploying $19 million into the project of my own money. But these are things I am very, very comfortable doing because of my temperament. Don't let somebody's aggressive, big vision, big thinking temperament, working 60, 80 hours a week influence you on what you should do with your with your money when yours is more chilling out. So it's not a, one size fits all. It's not. You got to kind of figure out what's for you.
So let me unpack this lag effect of these corporations having to pay their interest on the loan that they took. Take a look at this chart. If you look at this chart, this is corporate debt maturing in billions of dollars to the left. Roughly 790 billion matures. How much does it mature in 25? 1.1 trillion. And then it goes to roughly 1.2 trillion, give or take. 2027 stays at $1 trillion. 2028 goes closer to 1.3 trillion. How are they going to go all of a sudden from 2, 3, 4, 500 billion dollars to $1 trillion to 1.4 trillion, 1.5 trillion? And this is why when we asked the question at the beginning, who is the least optimistic about recession? 84% CEOs. Maybe they know something that others don't because they know that debt is coming. Remember a couple years ago how everybody was talking about that a market crash was coming? Everybody's like, oh my God, what if it happens? What if it doesn't? Now everybody's talking about it's going to be soft landing. There's not going to be any recession. And there's one thing that people forgot about, the saying, only the paranoid survive. So people are now, it's totally fine. Look at the market. It's near all-time highs. But is it really? If you were to pull out the top 7 stocks, when you see the numbers on this, it's staggering. And on top of that, there is an indicator of when a recession actually hits. And it isn't while we're raising interest rates, the Fed. It happens after we stop raising rates. And wait till you see how long it takes for the market to crash. But I've learned one thing for sure. Having been in the financial industry since the day before 9/11, only the paranoid survive, and those who are way too confident are typically wrong, and those who are way too cocky are also typically wrong. So here's U.S. interest rate hikes in the history of America. When we raise rates, we have never raised 4.88 percentage points as quickly as we did in the States. But what does this really mean? So if we look at the balance sheet of, this is pretty much the quantitative easing balance sheet, that shows how much bonds the Fed is buying. The M2 money supply shows how much money is circulating in the economy. So you notice, look how historically it's gradually climbing, but it's nothing that's sudden. We're not accustomed to, and we don't have another case study for somebody to say, well, here's what's going to happen. Well, it's totally okay. Well, don't worry about it. Based on what? Based on what case study can you speak so confidently saying nothing's going to happen? Everybody is almost protecting whatever business they're part of, investment they have. They're trying to sell why they're right and maybe don't worry about it, or do worry about it. But the reality of it is nobody knows 100% what's going on because we've never been here before. So let's continue. So then 2024 projections, what's next for the U.S. economy? They did a survey to find out who thinks a recession is coming. The Fed staff says 0% there's not going to be a recession. I remember they're in the business, so they're supposed to be saying that because that is Wall Street, right? Yield curve says 61% chance a recession is coming next 12 months. Economists are at 48%. Consumers are at 69%. That's Main Street, you and I. Goldman Sachs is saying only 15%. Bank of America, 35 to 40%. But look at CEO, 84%. Okay? C-suites are saying 84%. Now, what would CEOs know that the rest of them don't know? Maybe they know their debt payment. Maybe they know when their debt payment interest rates that they got was lower, that if they have to renew the debt that they got, it's going to go up here. How the hell are we going to make those payments? Maybe we ought to look at what some of these CEOs are talking about. You'll notice the percentage of S&P 500 companies citing keywords on earning calls. Inflation has decreased. Material costs decreased. Economical slowdown decreased. Job cuts went up, but it's also decreased. So could this be a sign that everything's going to be okay? If yes, why are CEOs at 84% saying a recession is coming? Are they Houdini? Are they Nostradamus? Are they somebody that can predict the future? What do they know that the rest of the people don't know?
But if you look at the United States compared to the rest of the world, inflation, I think, is closer to 2.5% at this point with a target of 2%. Unemployment, 4.2%, not bad. Stock market last year, 25%. This year, 15%. Market's doing good, but as we all know, there's a big difference between Main Street and Wall Street. But then you look at the Fed fund rate, what she's looking to do today, what it's at 5.25%, 5.5%. Prime rate's at 8.5%. So what they're ultimately saying is that this is probably going to be the last rate cut, potentially hike, doubt a hike, but until the election. So they're basically calling for him to basically go big or go home.
You think he's going to do half a
point?
So far we've talked about, imagine the average individual's like, look, dude, my school loan I got to pay for now. Now credit card debt went up all of a sudden to the highest it's ever been. Dude, I can't afford these payments. And you're noticing the defaults right now. You know, commercial real estate companies are defaulting on their payments. Subprime auto finance. So those people that don't have good credit that bought a car, they're starting to default with their payments because their interest rates are going up. They're defaulting. They can't afford to pay it right now. But who else is experiencing this? These were all small things we're talking about, right? You know who else owes a lot of money? What corporation in the world owes the most money? You know what that corporation's called? The great United States of America. You know what's going to happen to them every time interest rates go up? Let's break it down for you. So U.S. roughly owes $33 trillion of national debt. Math would tell you and I that each 1% increase in interest rates pushes the government's interest expense up $320 billion each percent. Each 3% is $1 trillion. Just interest increase not total, an increase of an additional $3 trillion at each 3%. So just to kind of put that in context, if you look at this chart, look what it shows you. This is the interest expense we've had in US from 1970 till today. You know how it's gradually gone up, but it's not been anything crazy. Then look at COVID. Boom, boom, skyrocketed. How are we going to make these payments? I have no clue, but they're going to come to you and I because it's really our debt. The government is we the people. You and I are running, we hired these people to run this corporation, but they come to you and I to fund it. So guess who they're coming to very soon? You and I. There are certain things you look at to be motivated and excited about the future. Take a look at this chart here. So again, remember this corporation we're talking about called the United States of America? Here's what this is. The green is the tax revenue our government gets every year from you and I. The orange is our GDP. The blue is our interest payment. And the red is our debt, the $33 trillion debt. Look how many years ago in 1980, everything was right next to each other. Just 43 years ago. They're neck and neck. All of a sudden, boom, the red goes off to the roof. It just skyrockets all the way to the top. GDP is a gradual growth. And guess what all of a sudden caught up to being the second highest now? It's our interest expense. This is not good news. This is why every time these guys don't want to go balance their budget, except they want to spend money, and people say, well, it's okay, you're just telling them, don't do your job, it's okay, keep spending money, I'm okay with that. This is our doing, because we voted these people in. You and I voted these people in, and they're managing U.S.'s finances in a reckless way.